Hello traders, Gary Wagner here, just about 10:15 in Honolulu, 4:15 in New York. It is Tuesday, August 23rd, 2016, and this is the Daily Report for Gold and Silver. As we await statements in a speech by Janet Yellen, that's scheduled for this Friday, so just 3 days from now, we do have the markets in a tepid state, in a wait and holding state, so to speak, pretty much across the board as far as financials are concerned. Precious metals also trading in essence unchanged. They've been up a couple of dollars to down a couple of dollars. Currently, we do have COMEX futures trading at 1342.70, puts it off about 70 cents on the day. The low 1338.90 and the high 1348.80. Now, silver also trading under pressure, a little bit more pressure than gold, but once again, only off about 3 cents on the day at 18.85. Let's take a look at our first chart. So traders, it does appear as though the market will close at about 42.70, off about 70 cents. As you can see on my daily charts, I haven't really updated actually. Let me go ahead and just change this to a 1440. It will scale it differently, but what we will get is more of a true representation of what we're looking at. Now we're at, 1342.70. Now, when we do that, we see a couple of things. First of all, I truly believe that we have an absolute base forming in the marketplace. If you look at these series of recent lows, they come in at roughly the same place. It's absolutely an area that we would have looked for support. It matches with a couple of fib numbers that we're looking at. These lows have seemed to have held. At the same time, what we have seen is a series of lower highs, which is what gives us this downward sloping upward resistance line, and a series of higher lows. So we're getting this compression triangle with a base forming. And as you know, my belief is that as it approaches the apex, and we are certainly getting closer and closer to that apex, there will be some sort of release of energy. I believe that that release should be to the upside because typically the markets will return after being in a compression triangle to the prevalent or predominant, I should say, trend that the market has been in. And it's certainly been up really since the beginning of this year. So we're looking at quiet activity, slightly lower close on the day. Low is above the low of yesterday. And as we talked about, I want to keep this stop rather loose because I don't want any kind of volatility to knock us out if in fact we're correct about the direction. At the same time, we certainly need it to take us out if we're incorrect about the break in the direction once we do see the market hit the apex and actually break out. So now traders, because of the way we have seen this market trading in terms of our technical models that we're currently looking at, I absolutely do not believe that we have broken away from there. I certainly believe, and this of course is back to our big picture of the long view, that we completed a major A when the market bottomed out at the end of last year, beginning of this year. From there, we went into our count. I believe we saw 1, 2, a 3, a 4, and a 5. From there, we went into a retracement. A, B, C is the way we've labeled it, which took us to conclude this minor second. Of course, this was our minor first. We are now in a minor third. Minor third, I believe, is going to be composed of 5 waves, of which we have seen waves 1, 2, we've seen wave 3 absolutely, and wave 4 completely form and complete. Now, I believe that we're in wave 5, and wave 5 is where we've gotten some difficulty because, as you can see, we were off to the races, and as we were off to the races, we stalled at the highs that were the former highs, roughly this area right in here. You can see that here and here, and so the key is this. Because of the fact that the retracement that we have looked at in terms of a fib retracement was an acceptable retracement, meaning it wasn't past a 61% retracement, we could absolutely be looking at a wave 5, something like a 1, 2, and then our 3 count to complete our wave 5, and that would of course have to really surpass these former highs right in here. However, let's assume, and I don't believe this is what we'll see, But again, these are just the ways we look at various models. But if we do not have, or gold doesn't have the ability really to take this out and begins to trade lower, well, what does that mean? Well, then you would have had a truncated fifth wave, and a truncated fifth in which you had, in essence, equal highs to 3 and 5. So it's called a truncated fifth, and you would go into some sort of a retracement, or into that would have completed our wave 3. We'd go into a minor wave 4. As I said, that's not what I'm looking for right now. But as we look at these markets, we want to, at all times, of course, look at all of the possibilities. And traders, lastly, silver. This is a weekly chart in silver. And I absolutely, as I look at this market, am still under the belief that silver could succumb to more pressure than gold. Of course, we had a dramatic spike in silver that wasn't represented in gold. Gold definitely didn't move with that same percentage gain. So when it comes down, it's going to be a candle that burns twice as bright but half as long, so to speak. I'm not surprised to see it correct heavily. The fact that it broke through this particular level, 1939, 50% retracement right in here, and that, of course, occurred last week, and our follow-through this week, tells me we could see this market drift as low as the 61% retracement, which comes in at about 1854. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for another weekly update and review. Bye-bye.